Hello, and you're watching Dukascopy TV. I'm Doireann Mc Dermott, bringing you the latest news on the BOE and ECB rate decisions. Interest rates were held as expected, and to discuss this with me in further detail, I am joined on the line by Christian Schulz, Senior Economist at Berenberg Bank in Frankfurt. First of all, Christian, let's have a look at the Bank of England. Now the sterling reversed its losses as the Bank of England held rates today. Now, before the meeting, the sterling actually hit a 2.5-year low against the dollar. This decision was predicted by most analysts. Now, were you also expecting this? And also, do you think we will see the Bank of England add stimulus before the summer?
Well, we were not surprised by both central banks keeping rates and policy in general unchanged. Clearly, the Bank of England was probably closer to changing the asset purchases and doing more QE than the ECB was to cutting rates. The last votes in the Bank of England's MPC Monetary Policy Committee were getting ever closer, and since the economy is still weak, it is likely that we once again had a very close vote. For the Bank of England, we do expect more stimulus, but whether that will happen before the new governor, Mark Carney, arrives is a big question. But once he does arrive, we think that the Bank of England will inject more liquidity into markets by doing more QE. Plus, there may be changes to the target of the Bank of England, so they may be allowed to keep inflation a little bit higher for longer.
Now, turning our eyes to the ECB, which also held rates today, Draghi said inflation risks are broadly balanced. Do you see this as a positive development?
Well, inflation at 1.8% at the moment is clearly on target for the ECB. The projections of the ECB see inflation decline further to 1.3% in 2013. But as the ECB points out, that is largely a welcome development because it reflects slightly higher inflation rates in those countries which have no competitiveness problems, which are healthy and growing, such as Germany, and those countries which are going through a pretty wrenching adjustment, trying to gain a lot of competitiveness in countries such as Greece or Portugal or even Ireland for that matter. So it is a healthy development overall, the ECB, and we do not see any risk of a widespread deflation and certainly no risk of a widespread inflation because of high unemployment rates either.
And in terms of downward revised growth expectations, in your opinion, what does this reflect?
Well, they've down-revised the growth expectation for 2013. They had been the most pessimistic of the international organization when they published their last forecast in December, so it's a bit surprising that they go even lower now. But the justification from the ECB is that the starting point, so Q4 of 2012, was so weak that even if you accept that the recovery will take exactly the same path as before, the outcome will be lower. So it doesn't reflect a change in the outlook of the ECB. It only reflects a different starting point. So we shouldn't read too much into that downgrade. The ECB remains pretty pessimistic about growth compared to other organizations, which also means that the ECB is less likely to be disappointed. And if the ECB is not disappointed, it will not see a reason to do more to stimulate the economy, i.e. another reason why there won't be another rate cut or any other measure.
Also, at the press conference, there were a lot of questions about OMT, especially regarding countries such as Ireland and Portugal. Now, Draghi said we all know the rules of how it works and reiterated OMT is not designed to help countries' market return. What are your thoughts on Draghi's attitude to this today?
Well, there are two sets of countries for which OMT could be interesting at the moment. One is the countries that are on the verge of leaving the bailout programs, especially Ireland and Portugal, which could need some support to smooth the transition to full market financing. What the ECB said is that while it will not pre-commit as long as these countries are still in their bailout, whether they will get OMT support or not, the ECB said that if they finance themselves on the markets, they may well be eligible, which actually should support markets' assessment of these two countries and help them. The other country that, of course, could be interesting in the context of OMTs is Italy. Italy at the moment, of course, doesn't have borrowing costs that should be worrying, at strongly below 5%. The country is certainly not unstable. But if it did have if panic really did set in the markets once again, of course the country would find it very difficult to apply for help and get a bailout. And since a bailout is a condition for OMTs, Draghi effectively sounded a warning to Italy that unless they get their act together and get the support of the other Eurozone members, they have effectively voted away that safety net of OMT, which has supported their borrowing costs over the last few months.
Draghi also said systemic risks from Cyprus may not be small. What do you think?
Well, this has been the line of the ECB, that Cyprus, of course, has problems, and these problems need to be resolved, but especially the focus should be on not risking the recovery and the return of confidence in financial markets by doing debt restructurings or making depositors of Cypriot banks contribute to this bailout. Cyprus is, of course, only 0.2% of Eurozone GDP, so a very small country, but that standard may not be systemic. However, anything that happens in Cyprus could set a precedent for other countries as well. It could spark bank runs if depositors are contributing in Cyprus. That could hurt countries such as Ireland or Portugal or Spain, which also have banking problems. And therefore, the ECB's position has always been to keep in mind the systemic consequences of anything that they do about Cyprus. However, of course, this doesn't really solve the problem, because the IMF and Germany are, for various reasons, concerned that a bailout for Cyprus would be too expensive for the country. So the discussions about this will continue.
And at this month's conference, Draghi returned to his original views on ECB, sticking with G20 consensus on FX. What do you think about this?
This is, of course, a change from last time around. Last time, Draghi pointed out the risks to price stability from a rising euro, and that was widely and probably correctly interpreted as the ECB getting concerned about the strong rise in the euro's value against other currencies. The fact that this time he reverted to the normal position of the ECB, which is not to comment on exchange rate, clearly indicates that the ECB is not worried about the euro's exchange rate at the moment anymore. So a value of 130 seems for the ECB seems to be perfectly fine against the dollar.
Thank you very much, Christian, for your views on this today. Well, viewers, that is it for right now, but do tune back in tomorrow as I will be bringing you the weekly wrap-up. But for now, goodbye.